Let me ask you three quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Hey, it's Mark Ferguson with Investor More, and you just watched Jerome Powell talk about higher interest rates, possibly raising housing prices and lowering affordability. And this is something that I was talking about in 2021 before it happened and what might happen. And I posted articles, I posted videos, I'll show you those. And now we are seeing it come to fruition, and it is not a good thing, and hopefully things change. But let's watch that full video, and then I'll talk about why what has happened has happened.
Housing. Higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you three quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments. So in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the synopsis. Bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees.
And what we were just watching was Jerome Powell of the Federal Reserve answering questions about interest rates and the housing market. Now, why this is important is because he had come out before and said he wanted to raise rates to slow down the housing market, make housing more affordable, when in fact it's actually done the complete opposite. And there's no secret that this might do the complete opposite before this happened as well. In fact, I did some videos of talking about what high interest rates do, what they've done in the past, and how they don't lower housing prices. A lot of people just assumed if rates go up, demand goes down and prices go down. But they forgot about one major factor: supply. Supply also goes down, supply gets more expensive. And to me, supply has a much greater effect on prices than demand does. So prices are up, cost of housing is up, inventory is down. All that is not good for the housing market if you want to buy a house. So why are prices up? Well, one major thing higher rates do is they decrease the amount of building. Right before interest rates went up, we had 1.2 million single-family homes being built. We're down to 900,000. It was down to 800,000 for a while, popped up, popped back down. And we were going a really good upward trend for a while. As soon as rates hit, it went drop down. It's been wavering right around this level. Well, if we have more building, we have more inventory. More inventory might not mean lower prices, but it could mean more stable prices and keeping those prices from going up like they have been recently. Many estimates say we're from 3 to 7 million houses short of current demand. So if we're not building enough, that's just kicking the can down the road. And people say, well, you can't lower interest rates now because housing prices will go up and demand will go up. That could happen, but building will go up too. And in the long run, we'll have more properties, more inventory. Whereas if you just keep them high, we're going to have less and less building. And that's just making the problem worse and worse down the road when rates do eventually go down. So do you want to tackle that problem now and get it fixed sooner, or make it worse and tackle it in the future, at the same time just not have enough housing for everybody? Inventory is also down, not just for building, but for people wanting to sell houses. People don't want to buy a smaller house for more money because interest rates are higher. So they're not going to sell, and they're not selling. And people who do sell are even keeping their old houses as rentals because their rates are so low. I know multiple people who've done that who would have sold normally if rates were kind of similar But instead, they're actually keeping their houses now and using them as rentals because they had such a low rate before. Something else, interest rates rising never lowered prices before. People have just assumed that low or high rates make prices drop. The 1970s had one of the highest interest rate increases in history. Not as high as 2022, that was the highest ever. But the 70s had one of the highest increases. Housing prices tripled in the 1970s. It massively increased the cost of housing, the cost of build. Everything went up. And I've said this before, rates increase costs. And if costs increase, prices go up. Builders aren't just going to lower prices and lose money. They're just going to stop building. That's how companies work. If you raise their costs, they're not just going to lower prices and lose money, they're going to stop producing. If you stop producing, that's less competition, less inventory. That's how prices go up. So increased rates makes basically every industry go up in costs because almost every industry borrows money or they get supplies from companies that borrow money. And when those costs increase, their prices go up. So all of these higher rates were a recipe for prices to go up, affordability to just sink like a rock because interest rates and mortgage payments went up so much, and lower inventory, which will make the housing crisis and housing shortage even worse in the future. So this was me in 2001 talking about what could happen if rates go up. And this is back when rates were at record lows, and discussing why we're not going to see a housing crash, why higher rates actually cause prices to go up in many cases. And I want to talk about affordability, and gosh, we were so lucky back then. But just some snippets of this, and then we'll post a full video below if you want to watch it. And the one thing I really want to talk about right here is how interest rates affect the affordability of a home. And a lot of people don't understand how amazing the environment we are in is right now because interest rates are so low, and how much money they're saving, and how much of an impact low interest rates make on a house or car or whatever it is they're buying. So if we were to take a $300,000 mortgage, a 30-year loan, and have a 3% interest rate, which is possible right now for a house you live in, your payment would be $1,264 a month. The principal you pay down would be $514 a month. That's how much you pay off the loan each month. And the interest would be $750. Now, what's crazy is people take this for granted right now. Like, oh yeah, buy a $300,000 house, my payment's $1,200. Now you'll have taxes and insurance and other costs there, but the loan part of it is $1,200 a month. That is insane. That is so amazing. Because if you look at the past, right, if rates go up 1% to 4%, your payment would be $1,432. But what's really interesting is your principal would be $432 paid off each month. So even though your payment is going up, the amount you pay off every month goes down because the amount of interest you're paying goes up so much. And so the higher the interest rate is, the more interest you're paying in the beginning of the loan and with the whole loan, but the less you're paying down your loan as well. So let's say the rates go up to 6%, which would be crazy. I do not think this would happen. It's another thing to consider is even if rates do go up this high, we'll talk about if it would hurt the real estate market or not, but it would be so, I think, unlikely to have them go as high. But just in case they do, if rates were 6%, your payment would be about $1,800 a month. And look at this, your principal goes down to just under $300 a month, interest $1,500 a month. So we go back up to here and compare this. You're paying off $216 less every month, even though your payment is $534 more a month. So this is why interest rates have such a huge impact on your payment and are so amazing right now. So this gives us an idea of why people think, oh, if interest rates go up, fewer people will be able to buy homes, homes will be more expensive, they have to go down in price. But we're going to look at the history here and see if that is really true or not. I'm still here. Do interest rates historically impact housing prices? Here's some really cool charts I got from the Fred, St. Louis Bank. Amazing stuff they have there. If you ever want charts, check that out. But I think we can click these and they get bigger. Look at that and prettier. So this is the bank prime rate over history that shows what the rate has done. And you can see it goes up and down pretty, often. In the late 70s, early 80s, it went crazy, over 20%. And it's been dropping really low, went up a little bit, dropping. So that's an interesting chart. All right, so another interesting chart right here. This is the median sales prices of homes. So you can see it's very pretty right here. Really pretty steady. Had a little dip here in the 90s, a little dip here, bigger dip here, been going up and up and up. But I was talking about the affordability before. So if you really take, a ruler and run it along here, yes, prices have been going up more recently, but it's not like they're just shooting straight up like this compared to historic prices. Yeah, they're higher, but they're not crazy high. So it's not something I'm super worried about. Now here you can kind of see these two charts together, which is more important. And what you want to look is like historically, do rates greatly impact housing? And this is a prime rate versus median sales price. And you see this, look at these rates going up. Housing prices. Well, we had a tiny dip here and a tiny dip there. And that's when rates were over 20%. We had a dip here in the late 90s, but rates went up a little bit before that. But if you look at the chart, they started going down before that dip happened. And well, rates started to go up here before the crash. Maybe those rates caused a crash, or maybe it's because of the horrible lending and absolute crazy building and all the other stuff. So there's not a whole lot of correlation here. Like if interest rates caused houses to crash, this should have caused like the biggest crash in the history of the world, and it didn't. It didn't hardly even cause a drop, just barely one. So we'll still keep looking. You know what else we have that's pretty interesting? These are actual mortgage rates. So before, we were looking at the bank prime rate, but it's also important to realize that just because the Fed prime rate, the Fed rates go down, that doesn't mean mortgage rates will follow them to a T. If you look at this chart, it's much less volatile. And you don't have those big giant ups and downs. You had this mountain here, this has slowly been decreasing. But in the early 2000s, when we saw those rate hikes, it didn't really translate to mortgage rates. A tad, they touched up a tad, but not that much, and they've been going down. So maybe it wasn't mortgage rates that caused that big crash right here. You see that dip there, or that big bump? Not here. So that's something else to consider. There's a lot of things to look at when looking at rates. Now, I know it took me a while to get to this. This is a cool chart my nephew made. It compares the two, mortgage rates versus the median housing prices in the United States. And so you can look at this chart and please tell me where the correlation is that shows really high mortgage rates cause housing prices to drop. Maybe a little bit right here. Like I said, a little bit, but we're talking about 2 or 3% drop right here. This is about a 5% drop right here. This is about a 30% drop right here. You just don't see it. You see these rates jump up here. I mean, that's a pretty big jump in rates. No decrease. Another pretty big jump in rates right here. No decrease. A huge, massive jump in rates. Very small, minimal decrease. Along here, we keep seeing rates drop and drop and drop. And what you might see is that a drop in rates could cause prices to go up. We have a pretty good drop right here. Did that help cause the housing boom? Possibly. Then we saw, another drop as the economy tanked. The Fed just kept dropping it, and that could have helped cause prices to go up. So there might be some correlation between prices going up and interest rates going down. But is there any historic evidence of high interest rates causing a crash? I have not been able to find any. Now, that's me talking. And one thing before we get into the studies, because I'm not just going to talk about it myself. There are multiple studies that have talked about this as well. For fun, what would your payment be on a $300,000 house at 18% interest? Back here. $4,500 would be your payment if the interest rate was 18,000 or 18%. You remember up here? It was $1,200. Now it's $4,500. And guess what? $4,500 is interest, $21 goes to principal. That's how crazy it was back then. And you know what's really crazy? If you paid that house that rate for 30 years, you would have paid $1,327,000 and $652 in interest over that loan. Do you know how much interest you would pay if the interest rate is 3%? $155,000. So it is so crazy to compare now to the early 80s and how much better it is to use loans and debt. But even with these astronomically crazy numbers and ridiculousness, the housing market did not crash. It barely had a blip. It just kept moving along steady. So to me, that is pretty clear that interest rates do not cause the housing market to crash. All right, we are back in 2024. And I wanted to show the single family new home starts to show you what happened when interest rates shot up. So you can see they were very, I wouldn't say steady, but there's definitely an average number of builds that were being put out every decade. There were some ups, some downs, and then before 2008, we had a big increase in oversupply of houses. A lot of that's what caused the crash. Then we had a record low amount of building for a long time, and we're just getting caught up to average. And this is why we have so few houses and such a shortage of houses in the US, because they built below average for a decade, record amounts below average. Well, we got caught up close to average, and then they raised interest rates and the bottom fell out again. They stopped building. Then there's like, well, they're going to lower rates. Inflation looks better. They're going to start again. They built more, then it decreased. But we're not even close to where we need to be to catch up on housing. We're not even really close to average. So we're still falling behind. If they had kept rates low, I know people think I'm crazy when I say that, housing probably would be in a better shape because they would have kept building, and they could have built houses cheaper because of scaling. I know people don't believe this either, but I own a liquor store, I own businesses. If I sell more stuff, I can sell it for cheaper. I get discounts from my suppliers, I have more profit, even though my profit margin might be lower. If I'm selling more stuff, I can make more money. But the idea of raising interest rates is that you want to kill demand and force companies to lower prices. Well, if you kill demand, it means you're selling less stuff. You lose your discounts, you lose your bulk ordering, you make less money. Companies don't just lower prices, they go out of business or they raise prices when high rates go up. And that happens in building, that happens with construction companies, service industries, all of them, costs go up, and we've seen that happen in housing for sure. So we'll see what happens. Hopefully they lower rates. It makes housing more affordable. Everybody's happier here soon. Will they do it? I don't know. They raised rates higher than ever in history before really knowing what was going on, and said they had to do it to be safe. And now they're saying, well, we can't lower rates too fast because we've got to be safe. So it's a tricky situation. I honestly think the market knows a lot better than the Fed on what is good and what works well, and low rates make prices cheaper. They allow people to make more money. They usually help out in a lot of different ways. And really what caused inflation, in my opinion, is a lack of supply. Is they shut down businesses. They didn't let people create things. They didn't let people work. And people did not have the ability to buy things because those things weren't available. And that increases costs. Because companies are selling less goods, they have to increase costs to make the same profit. And if you look at the other instances of super high inflation in the history of the U.S., World War II, World War I, even after the Vietnam War, which could have been oil crises as well, it wasn't printing money. It wasn't massive amounts of money being put into the system. It was no supply. It was cutting off supply, stopping companies from building, or just like an energy crisis. Now, yes, World War II saw Germany print trillions of dollars of money, and they cause inflation by doing that. But we aren't printing trillions and trillions and trillions like they did. Yes, we're printing a lot of money. Maybe it's too much money, but it's not to the scale that Germany did. And I think we've seen in many other instances where there was really high inflation, and it wasn't caused by massive money printing. So looking at the data, looking at what's happened, we'll see if they lower rates or not. If they don't, we'll probably see low inventory, less building, and a continued housing crisis well into the future. If they do lower rates, hopefully that means more building, more supply, and a more stabilized market. Of course, If the governments came in and decided to lower development restrictions, to make it easier to build, to lower building code requirements, that would massively decrease the cost to build. But I can't imagine that will ever happen. All right, we'll be back with more videos of my flips, rentals, businesses, all of that soon. And once in a while, we'll do videos like this and analyze the market and what's going on as well.